Welcome back. After posting an impressive 42.3% return in 2017, the Nigerian equities market started off on a positive note in January with year-to-date return as high as 17.9%. Shortly afterwards, market has retracted with the general investor sentiment best described as weak. Notwithstanding the somewhat impressive 2017 full-year results released on the ongoing first quarter earnings season, equities continue to underperform, with some investors contemplating selling in May and going away. Now, what do equities hold for the rest of 2018? And are there still bright spots for the market in the build-up to the 2019 general elections? Should investors sell in May and go away, or are there still cherry picks possible for potential upsides? Joining me now to provide answers to some of these questions is one of the investment analysts at Afrinvest Securities Limited, Omotola Abimbola. Good morning, Omotola. Thank you very much for joining us. Now, the current bearish phase, we're seeing in the equities market appears to be the longest the market experienced, after launching the INE windows in April. And you just released a report titled "Foreign Investors Still Calling the Shots." Can you talk us through the major highlights of this report?
Okay, thank you for having me, Chimeze. Essentially, in the report, we looked at the developments in the capital markets since the introduction of the high-and-low window in April 2017. So we took stock of things in the market since then, particularly looking at the level of foreign direct investments in the economy since the window was introduced, as well as FPI investments. We also considered the level of valuation in the market to answer the question as to whether the market is overvalued at this moment, or we expect to see an upturn in performance going forward. So broadly speaking, it's a report which looked at the capital market environment since the window was launched and the outlook for the market for 2018.
Okay. Now, it would seem that Nigeria has barely attracted the much of FDI flows since the launch of the INE, unlike the EPI. Would you say this is having a negative impact on the sentiments in equities?
Maybe so, and maybe not, because, like you mentioned, since the INE window was launched, we have seen a significant rebound in foreign portfolio investments. For full year 2017, we recorded over $7 billion of FPI investments in the economy, of which it was over 6 times the level that was recorded in 2016, and it was the highest that we have seen since 2014, when it peaked at over $14 billion. But on the contrary, for foreign direct investment, we recorded the lowest level in nearly a decade in 2017, which is in sharp contrast to what we saw for foreign portfolio investments. And there are many reasons that we can adduce to this, because FDI investments, they are typically long-term investments that are hardly liquid. They're not so liquid like foreign portfolio investments, where the investor can simply, with a call, place to a trader, exit his investments, and repatriate back to the home country. For FDI investments, they are not that liquid, so considerable level of due diligence has to be done on the investment opportunity before capital is deployed. For an FDI investor, he has to look at the macroeconomic landscape, look at the industry he's going to be investing, and the fundamentals of the company he's investing as well. So for us, although we have seen a subtle upturn in macroeconomic environments, there are still some structural bottlenecks that are constraining the level of FDI investment in the country. Typically in Nigeria, over the past 6-7 years, a surge in FDI investments, they are often driven by liberalization of the economy or opening up of particular sectors. For instance, when the federal government at the early onset of the last decade, when they opened up the telecommunications industry, for private investors, we saw an uptrend in FDI investments going to that sector. In the last political dispensation as well, the last administration, we had the power sector reform, which opened up the sector to new capital, to new investment by foreign direct investors. But this time around, there are so many bottlenecks that are constraining foreign investors, direct investors, I mean, from taking on the opportunity that still exists in the economy. Because Nigeria is still a developing country. per capita income is still very weak, and there is just so much potential for investors to come in. But there are so many structural constraints, such as so what we are seeing in the downstream oil and gas sector, where we still have regulated prices, which is to anybody who wants to invest in the downstream oil and gas sector, he has to worry about the prices that NNPC are going to peg the PMS prices particularly, and also whether the subsidy will be paid going forward. So that's one of the factors. Also looking at the power sector as well, because we're living in a global economy that is very competitive. We are competing not just with countries in West Africa, but with the rest of the world, for manufactured products. So if I want to make Nigeria my manufacturing hub, I have to worry about the power situation. And right now we're having a power sector liquidity crunch that has constrained the growth of the power sector since it was liberalized in the last 3 or 4 years. So what we advise the policymakers to do is that beyond the macro stability that we are seeing right now in the economy, with declining inflation level, improving growth profile, stability in the FX market, accumulation in external reserves, all these things are positives, and they are a testament to the improving macroeconomic climate. But for you to attract FDI in investments, for you to make your country attractive, you have to make it structurally competitive as well for investments. So things have to be put in place in the power sector, in the downstream oil and gas sector, regarding the fiscal viability of our subnational governments who are still cash-strapped. So these are the short and long-term issues that we have to face, head-on to be able to attract FDI investments into the country.
Okay. So what would you say is the reason for the drastic correction the market has experienced since February of this year?
Yeah, quite rightly. In your introduction, you said that in January, we saw year-to-date return for 2018 peak at 17.9%. But since then, the market has lost over half of that gain. And currently, year-to-date return is less than 9%. And there are so many theses that have been attributed to this. One is the fact that forward earnings might not be sustainable going forward, because if you look across the sectors of the capital of the equity markets, earnings results in 2017, which I must say were quite strong, was partly driven in some sectors by some unsustainable factors. In the consumer and manufacturing goods sectors, for instance, it was driven by increase in products prices, which led to higher margins. In the banking sector, it was driven by higher interest income in government securities due to the tight monetary policy by the central bank. But some of these things are changing in 2018. 2018 so far, for instance, we have seen a downward trend in fixed income yields. Average yield on government bonds last year was as high as 16.5% at the beginning of last year. Today, they are around 13.5, 13.3%. T-bills rates have crashed significantly. From the 1 year tenor used to yield over 18%, over 20% yield, effective yield before. Today, it is about half of that. So there is a bit of skepticism on whether banks will be able to sustain that earnings momentum going forward, which is why we saw a bit of sell-off in the banking sector in the later part of the first quarter of 2018. Another factor which I could say is responsible for this is due to some domestic investors who for the first time in 34 years are seeing dividend yield in single digits. Because of the market correction that we witnessed in 2016 and 2015, dividend yield for blue chip stocks, it was quite high. We're seeing many in double digits. But this time around, because prices are already very high and dividend cannot track the growth in share prices, we have seen dividend yield reduce quite considerably. So even though we're seeing very solid earnings results being delivered, the fact that dividend yields are now lower than what we saw in the last 2-3 years even reduced the appetite for some retail domestic investors investing into the equity market. But by and large, despite these two factors that I mentioned, we still think that the market still has potential to record substantial gain in the medium term.
Okay, recalling the substantial, a lot of people believe that with the fixed income market, the yield,
correct,
the fixed income market going down, the equities market will probably have to gain.
Well, maybe there's no direct correlation because earnings will be affected by, particularly for banking sector, by decline in government securities as well. But you are quite right in saying that theoretically, you should probably see an upturn in the equity market because the discount rates for even valuing equity securities would have reduced. Opportunity cost has reduced, right? It's a factor, But beyond that as well, we think there are some other fundamental factors that should propel equity markets to a positive performance in the medium term. The first is the improving economic climate. For 2017 rather, was a recovery year. Growth was barely 1%. But 2018, IMF is forecasting 2.1% growth in GDP. We are a little bit more optimistic. We are forecasting 2.6% growth in GDP. Although that still means that per capita income will still decline because population growth is above 2.7%. But we still think that should probably lead to some single-digit earnings growth, for the benchmark index in 2018. So with earnings growth expected to continue, although at a slower pace, and also the decline in the discount rates for valuing equities, we think fundamentally there's a compelling case to see equity valuation even rise further in the medium term.
Now, the big question there is, should investors sell in May and go away?
Interesting question, I must say. We're a bit nuanced on that question. We think how you answer that question and how you allocate your assets is dependent on your investment horizon to even start with. Right now, in the short term, there are some downside risks to capital markets performance, key to which is the political environment. Typical of frontier markets, in periods leading up to political elections, but general elections, we usually see volatility in the capital markets. So that's a key downside risk to market performance in the short term. So if you want to sell in May and go away, you're probably a short-term investor, worried about volatility that could ensue, very soon. But if you're a long-term investor, we still think that the market's valuation is still appropriate at this level. So
investors shouldn't actually be worried, particularly with the upcoming elections. Is that what you're saying?
There is a concern for the upcoming elections because, like I mentioned initially, typical of frontier markets, if you go anywhere, ranging from SSA frontier markets to even, Asia-Pacific frontier markets, during political elections, we usually see volatility in the capital markets, because of foreign portfolio investors. And like mentioned in our reports, foreign investors are a major driver of liquidity in the local markets. Before the high window was long, we used to record about 2 to 3 billion naira of daily transactions in the equity markets. After they came back, we were recording between 6 billion to 8 billion naira of daily transactions in the equity market. So they are an important driver of liquidity, and they are always wary of political tensions, in the market that they're investing in. So there's no doubt about it. There's going to be volatility in the equity markets, and even more so because, unlike the last unlike typical of political, if the incumbent is seeking for re-election, typically, there are usually higher odds of the incumbents, retaining the political seats. But in this case, we think that the 2019 general elections will be keenly contested by both parties, because of the disaffection we are seeing with the economy and the ethnic tensions that we are seeing all around the country. So with a keenly contested election upcoming, we expect to see lots of volatility in the equity market. But if you're a medium-term investor, we still think that it is appropriate for you to hold on to your asset allocation.
Okay. Now, you adduced in your equity notes that foreign investors still call the shots, yet values of transactions seem to be, on the rise. So how accurate is your hypothesis there?
Activities in the markets could be driven either by selling or by buying. When the activity level shot up at the beginning of 2018 in January, it was due to buying interest. Now, we still have very robust level of activity, but it is now more tilted to the selling side, particularly by local investors who are still skeptical about forward earnings, as well as single-digit dividend yield.
Okay. Thank you very much for your time, Omotola Abimbola.
Thank you.
Omotola Abimbola is one of the investment analysts with Afrinvest Securities. We'll take a break, and when we come back, we'll look at Nigeria Investment Promotion's drive to attract domestic direct investment. Do stay with us.